How to become a millionaire by 30. Reaching seven-figure status by age 30 may sound mythical, but it certainly is possible as long as you have a solid financial plan, broken down by specific milestones and tracked over time. Check out this video to understand why achieving millionaire status is doable if you take appropriate steps and plan ahead. The secret of how to become a millionaire begins with understanding which financial habits can help you grow wealth. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. I'm doing marvelous today, if you were to ask me. And if you are doing as wonderful as I am, go grab a cup of coffee or tea or vodka. Now let's roll. Today, I want to talk to you about how to become a millionaire by 30. What you want to do is you want to start early. One of the most important things we've seen when it comes to reaching wealth at a very young age is to have a plan. And a much more important, much more powerful tool you have for saving 1 million by age 30 is time. As you save and invest, your money earns interest. That interest compounds. That's the magic of compounding interest, meaning your interest is earning interest. Think about that. So you have the principal, which is the money you originally invested, and then you have interest. And your interest is earning interest. Isn't that beautiful? The sooner you begin saving and investing, the longer your money has to grow. Let's take this example. Assume that at 16 years of age, 16 years of age, you got your first job and opened a Roth IRA. This could be a job at the local McDonald's or as a clerk at the local law firm. So you contribute $5,500 to your account each year up to age 30. Earning a 6% annual return. So from 16 years of age to 30, we're talking 14 years here. 14 years, 6% annual return. That would give you a little over $122,500. Nice package, right? Now, let's say you get your first professional job at age 22. So you graduate from college with your bachelor's degree in finance or a bachelor's degree in law or marketing, and you get a good job. Your employer offers you a 401k match worth 100% of the first 6% of contributions you make. To max out the $18,500 contribution limit allowed each year, you contribute 37% of your $50,000 salary. Let me repeat that. To max out the $18,500 contribution limit allowed each year, you contribute 37% of your $50,000 salary. With a 2% annual raise and a 6% annual rate of return, you would have over $216,000 in your plan by age 30. Folks, this boils down to math. It boils down to arithmetic. It's all about making sure that you're using time and that you are saving and investing as much as possible. So you gotta start early and you have to take specific steps. So I'm just want to walk you through this example to show you the power of interest. So let's continue with our example here. So far, we have accumulated what? More than a third of your $1 million goal, right? So $122,500 that you have accumulated by when you first had your first job at age 16, and then you got your first professional job at age 22. So you would have $216,000 in your 401k plan. All right. Now, if you were to continue saving it at the same pace, earning the same rate of return, 6%, you would easily have $1 million by age 40. By age 65, that would grow to more than $6 million. The point I'm trying to make here, folks, is that it is important to have an early start, and it is important to use the power and magic of compound interest so that you can attain your wealth goals easily and quickly. Starting to save early is essential for any retirement plan. Anything you put away in your 20s has 40 years or more to grow before you retire. A few dollars can go a long way. Now, to reach a millionaire status by age 30, Besides savings and investing, one of the things you need to do is to start hanging out with people who actually are already millionaire or know how to get there. So you need to hang out with the right people. You need to talk to the right people. You need to read books. You need to educate yourself. It's not just about imagining things to happen. You have to take specific actions on a daily basis to make sure that happens. And there are 3 things you have to do. So by starting early, which is the first point, there are 3 things you need to do. Hang out with the right people. You need to educate yourself. And this means reading financial articles. You can go on the Wall Street Journal or Bloomberg, watching TV. You want to surround yourself with what millionaires do, how they educate themselves. That's number 2. So first, your entourage. Second, education. And the third thing is emotion. Those are what I call the 3 E's. What is emotion? Emotions mean that you have to develop a healthy, a positive relationship with money. You have to look at money as something good. You have to want it. You have to seek it. You have to cherish it. Believe it or not, a lot of folks have a questionable rapport with money. They think it's bad, it's dirty, or people say money is the root of all evil. That's just BS. You want to love money. It's not money itself that's the root of evil. It's the love of money. It's greed. But we're not getting into any philosophical discussions here. My point here is to tell you how to become a millionaire by 30. So emotion, entourage, and education. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Sweetie Kiwi Show. I hope that you are doing fantastic. I want to continue the conversation. I was telling you earlier that you have to start early when it comes to investing, so you can take advantage of the power and magic of compounding, interest compounding. Now, the second thing you want to do is to save to invest. So in the last example, I showed you that it is possible to save close to $340,000 just by saving in your IRA and a 401k. But you still have some ground to make up to get to 1 million, right? So how do you do that? If you want to learn how to become a millionaire, you need to know the differences between saving and investing. And you can get those differences through what I told you about education, emotion, and entourage. When you're saving money, you're most likely putting it in a low-risk vehicle, such as a savings account, money market account, or a certificate of deposit. Some people even invest in U.S. Treasury bills, U.S. Treasury notes, or bonds. Even though this is some kind of investment, it's still low risk because investors assume that the United States government will never go bankrupt. These accounts are safe, meaning the odds of losing money are low. But you cannot generate significant wealth when you're earning a low rate of return on what you save. When you invest in things like stocks, mutual funds, ETFs, electronically traded funds, or real estate, you increase the risk factor. The trade-off, however, is the potential to earn much higher returns. So you have a simple yet clean synergy between risk and return. That's the risk and return trade-off, right? So the higher the risk, the higher the return, and the lower the risk, the lower the return. So you need to find a right balance of risk. You need to find a right risk-return balance for your particular investor profile. So if you're young, usually if you want to reach a millionaire status, you want to reach millionaire status by 30, that means you are younger than 30, which means you can take risks. You can invest in stocks. You want to invest in stocks so you can take advantage of volatility. Of course, I'm not asking you to do things in a nonsensical way here. You want to do things in a wise and shrewd way, but you need to invest. You need to take action. So when you invest in those instruments, in reasonably volatile instruments such as stocks and mutual funds, you are increasing the risk factor, but you're also increasing the return. And this is very important. So this is critical to it. It's critical because there is a quintessential difference, as I said before, between saving and investing. You will never reach a millionaire status through saving unless you are saving a lot of cash every single quarter, or every single month, or every single week. That, yes. But if you are earning less than 6 digits, like most Americans, and after paying everything else, after paying your taxes, you don't have a lot left. Even if you do, it will take you a number of years before you reach a million. Let's say you are saving $10,000 or $10,000 every year. It will take you 100 years. If you're saving 10,000 every month, it will take you 100 a month. 100 a month, that's a little bit less than 9 years. Versus if you were to invest in a good stock and a good portfolio of stocks and bonds and mutual funds and ETFs and commodities, and you're earning 20%, 15% double digit returns every year, your chances of reaching millionaire status are higher. Now, let me illustrate what I mean here. Going back to the previous example, assume you took the same $5,500 you could put into a Roth IRA and you save it into a high yield savings account instead. That account will probably earn 1%, or if you're lucky, 2%, and that's compounded monthly. If you save that amount each year from age 16 to 30, you would earn approximately $16,000 in interest. The Roth, however, would have grown by $55,000, assuming a 6% return. Now, 6% return, that's very conservative. And overall, over the last 10 years or 15 years, the market has posted on average 10% to 11% annually. So we have been very conservative here in using our example as 6% return. It might sound wise to have some cash tucked away in an emergency savings fund. You still need to invest if you want to reach $1 million by age 30. Maxing out tax advantaged accounts such as IRA and 401k will get you closer to the deal. Utilizing a taxable brokerage account to invest in the market can help fill the gap. So you will pay capital gain tax when you sell an investment in your taxable account at a profit, but that may not be an issue if you are investing for the long run. Capital gains tax at the moment fluctuates between 10% to 20%. That's just an average of 15%. So even if you were to sell the investment, you will still be better off in the long run and getting closer to your $1 million goal than if you were to put your cash in a savings account. Again, as I said earlier, 6% is a conservative percentage. A lot of investors, especially the rookie investors, are kind of scared about the ups and downs of the market. You can't look at the ups and downs of the market on a monthly basis or quarterly basis. You want to take a long-term view here. You want to take a 5-year or 10-year view so that you know overall the market come back and the market always goes back up. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic and you are learning a lot from our show today. And if you love the clarity and quality of the content so far and you want to reach a millionaire by age 30, please consider subscribing to our channel and turn on the notification bell. We'll surely appreciate that. Also, please like this content, share, and comment below if you have questions. Our team reads all questions, and we will certainly get back to you if the question is relevant. The third thing you want to do is diversify your income streams. If you want to get rich in general, you want to reach wealth, you want to diversify your income streams. You want to have multiple sources of income. Working at a full-time day job can help you generate income to invest. But if you are on a path to reach $1 million by age 30, you need to add other income streams to the mix. Freelancing is kind of cool. We have the gig economy right now. People can work on Uber, on the internet. You can, if you're good with grammar, you can be a copywriter. You can, if you're a photographer, there's a lot of stuff to do. So freelancing is a great option for many. We have about 57 to 60 million Americans who do some type of freelance work, according to Upwork and the Freelancers Union. So starting a side hustle by offering freelancing writing, being a virtual assistant, or providing coding or design services could lead you to earn more income that could fuel your portfolio into $1 million investment strategy. You can also, if you're not really, if you have a knack for property management, you can invest in real estate. Of course, the upfront capital is higher, but again, if you have the skills, you have the going back to the 3E I was talking about earlier. If you have the entourage, in other words, you have the network, you have the education, you know a little bit about the industry, the real estate industry, and you also have the emotion. So you have a positive emotion with money. You learn to you love to earn money. That is pretty good. Owning a rental property, for example, can generate a steady stream of income monthly. The income is passive, meaning it comes in regularly as long as you maintain consistent tenants, right? So you are sleeping, but your money is working for you. Your property is generating income for you. Additional ways to build passive income include investing in peer-to-peer loans. Those have been very popular in the last few years on the internet. So you are basically investing in a pool. You're putting cash into a pool of money, and that collective cash is used to finance businesses and finance individual loans, and then you're gonna cut out of that, and you can create and sell an online course or product. That's another great side gig. You can try affiliate marketing. We have entire shows on all those sources of passive income I'm referring to in this show, so you might want to double check our videos. We have a playlist and it's pretty well organized. You can also rent a room in your home on Airbnb. Some of these methods require more of an initial investment of time and money than others, but they can lead to regular income to supplement your paycheck. And this is what you really want. To be able to get to the $1 million mark threshold ASAP, you want to diversify the amount of income you have. So instead of saving 10 grand or 20 grand or 25 grand, you are saving or generating 50 grand, 75 grand. Another thing you want to do besides diversifying your income streams is to track your goals and know your value. This is a numbers game, folks. $1 million is a numbers game. So if you save and invest, if you want to save and invest $1 million by age 30, that's great. But remember, it's a huge target. It's a huge target to hit, and it helps to track your progress. You want to break things down into smaller goals so that you can see the process at a more manageable level. For example, you can look at things on a monthly basis, quarterly basis, and annual goals so that you're able to see your progress. As a matter of fact, I have a friend of mine who tracks these things on a weekly basis so that he can reach his $1 million goals even sooner. And the last thing I heard from him, he has reached that goal about 2 months ago. So it is also critical to be conscious of your value and how that correlates to your ability to build wealth. Value means what? Value, again, goes back to what I told you about the 3 E's. So value is a determinant, is a byproduct of the 3 E's I referred to: education, entourage, and emotion. If you have the perfect education and you're able to network properly, you can increase, for example, your value at work. You can increase your value in the neighborhood. You can increase your value to freelance clients. So you can increase not only your salary at work, your worth in the neighborhood, and also your worth when it comes to your side gigs. You can charge more. Negotiating a raise at your job, for example, could yield more income with which to save. Using your skills to become a freelancer or sell a product online could do the same. The key here is to know your true worth and how to leverage it to reach your goal. That's it, folks. I really appreciate your attention today. I want to quickly give you a recap of today's show: how to become a millionaire by 30. 4 simple things. Start early, save to invest, diversify your income streams, track your goals, and know your value. And to wrap it up, remember the 3 E's, folks: education, entourage, and emotion. Have the right emotion to money, vis-a-vis money. Surround yourself with the right people and educate yourself. Read books, watch important news shows, financial shows. Learn from the experts. Learn from the best. Pay attention. I will see you next time. But until then, remember, stay marvelous.